Welcome to Lesson 6 of Week 8. Building on our overview of indirect costs, today we explore how facilities and administrative rates are actually calculated and negotiated. Understanding this process helps you appreciate why your organization's rate is what it is and how the rate determination system works. Rate calculation is a specialized function typically handled by your organization's cost accounting or sponsored programs finance staff. Most grant writers do not calculate rates themselves. However, understanding the process helps you explain indirect costs to stakeholders, answer questions about your rates, and appreciate the regulatory framework that governs indirect cost recovery. This lesson will walk through the cost pools that feed into rate calculations, the allocation bases used to distribute costs, and the negotiation process with cognizant agencies. We will also explore practical considerations for organizations at different stages of their indirect cost rate development. Remember that regulatory specifics discussed were accurate as of November 2025. Verify current requirements at ecfr.gov. By the end of this lesson, you will understand the foundations of indirect cost rate calculations and be able to discuss rate-related matters knowledgeably with colleagues and stakeholders. The fundamental concept behind indirect cost rate calculation is straightforward. Divide total indirect costs by an appropriate direct cost base. If your organization has $1 million in indirect costs and $2 million in direct costs, your rate would be 50%. However, the practical application involves considerable complexity. The basic formula is indirect cost rate equals total indirect costs divided by direct cost base. This simple relationship underlies all rate calculations, though the details of what goes into each component can be quite involved. Cost pools are categories of indirect costs grouped for allocation purposes. Rather than tracking every individual indirect expense, similar costs are pooled together. Facilities costs form one major pool, administrative costs form another. Each pool is then allocated using an appropriate method. The allocation base is the direct cost measure used to distribute indirect costs. Modified total direct costs is the most common base, but other bases may be used for specific cost pools. The base should reasonably represent how indirect costs relate to direct activities. Organizations may have multiple rates for different types of activities. Research might have a different rate than instruction. On-campus activities might have a different rate than off-campus work. These variations reflect genuine differences in how indirect costs relate to different activities. Facilities costs represent one major component of indirect costs. These costs relate to the physical infrastructure that houses and supports your organization's activities. Building depreciation spreads the capital cost of buildings over their useful life. When your organization constructs or acquires a building, that investment is not expensed immediately, but depreciated over decades. Annual depreciation charges represent the portion of that capital investment consumed each year. Operations and maintenance costs cover running and maintaining facilities. This includes janitorial services, groundskeeping, building repairs, utilities like electricity and water, and general facilities management. These ongoing costs keep buildings functional and usable. Interest costs for building financing may be included subject to federal limits. If your organization borrowed money to construct facilities, the interest on those loans represents a real cost. Federal regulations allow recovery of some interest costs but impose limitations to prevent excessive recovery. Equipment depreciation for non-research equipment may be included. Equipment like office furniture, computer systems for general use, and facilities-related equipment gets depreciated over its useful life. Note that research equipment purchased with grant funds is typically not included in this pool since it is charged directly to grants. Administrative costs represent the other major component of indirect costs. These costs relate to management, oversight, and support functions that serve the organization broadly. General administration includes executive leadership, legal services, institutional planning, and overall organizational management. The President's Office, board support, institutional counsel, and strategic planning functions fall into this category. These functions guide the organization as a whole. Sponsored Programs Administration covers functions specifically supporting grant management. Your grants office, research compliance, and related functions support sponsored projects but do not work on any single project specifically. These costs enable effective grant management across your portfolio. Departmental administration includes unit-level administrative support. Department administrators, business managers, and administrative assistants who support multiple faculty or programs contribute to this pool. Their work enables research and other activities within their units. Student Services Administration applies to institutions with students. Registrar functions, student affairs, and related services support the educational mission. For institutions where research and education intertwine, student services costs may be allocated partially to sponsored programs based on their supporting role. Different types of costs are allocated using different methods that best reflect how those costs relate to activities. Understanding these methods helps explain why rates are calculated as they are. Space allocation distributes costs based on square footage used by different activities. Facilities costs like depreciation, utilities, and maintenance relate directly to space utilization. If research activities use 40% of building space, they receive 40% of space-related costs. Modified total direct cost allocation distributes costs based on MTDC expenditures by activity. Administrative costs often relate to the volume of activity conducted. If research represents 60% of MTDC across the organization, research activities receive 60% of administratively allocated costs. Salary allocation distributes costs based on salary expenditures. Some costs relate most directly to personnel rather than overall spending. Human resources costs, for example, relate to the number and compensation of employees rather than total program expenditures. Hybrid methods combine different allocation approaches for different cost pools. Facilities costs might be allocated by space while administrative costs are allocated by MTDC. This mixed approach attempts to match each cost pool with the allocation method that best reflects how those costs actually relate to activities. Organizations seeking negotiated indirect cost rates must go through a formal proposal and negotiation process with their cognizant agency. Understanding this process helps you appreciate what underlies your organization's rates. The cost study documents actual indirect costs by category. This detailed accounting exercise identifies all costs that qualify as indirect, organizes them into appropriate pools, and documents the total amount in each category. The study typically covers a complete fiscal year to capture the full cycle of organizational activity. Allocation analysis determines how costs relate to different activities. This step calculates the appropriate allocation of each cost pool to different functional areas. The analysis produces allocation percentages that will be applied to determine how much indirect cost each activity should bear. The rate proposal submits proposed rates to the cognizant agency for review. The proposal includes the cost study, allocation analysis, and proposed rates along with supporting documentation. The proposal should demonstrate that the methodology follows regulatory requirements and produces rates that fairly represent indirect cost relationships. Negotiation with the agency reaches agreement on final rates. Agency staff review the proposal, may request additional documentation or explanations, and may challenge specific elements. The process concludes when both parties agree on rates documented in the NICRA. Indirect cost rate proposals require extensive documentation to support the proposed rates. This documentation enables cognizant agency review and protects the organization during audits. Financial records must provide detailed accounting supporting each cost pool. Every dollar included in indirect cost pools should be traceable to specific financial transactions. General ledger accounts, subsidiary records, and transaction documentation should support the aggregated totals in your cost study. Allocation-based documentation shows how allocations were calculated. Space analyses documenting square footage by activity, salary analyses showing personnel costs by function, and MTDC calculations by program area all support the allocation percentages used in your rate calculation. Methodology descriptions explain the methods and assumptions underlying your calculations. Why did you choose particular allocation methods? What assumptions did you make where data was incomplete? How did you handle unusual circumstances? These explanations help reviewers understand and evaluate your approach. Reconciliation ties rate calculations to audited financial statements. The totals in your cost study should reconcile to your organization's audited financials. This reconciliation provides assurance that the indirect cost pools are complete and accurate, not fabricated or inflated. Organizations without negotiated rates have an alternative, the de minimis rate. Understanding this option helps organizations make informed decisions about their indirect cost approach. Eligibility for the de minimis rate requires that your organization has never had a negotiated indirect cost rate. Once you negotiate a rate, you cannot go back to de minimis. Organizations considering their first rate negotiation should weigh whether the de minimis rate or a negotiated rate better serves their needs. The de minimis rate was 10% of modified total direct costs as of November 2025. This rate is specified in federal regulations and may be used without further justification by eligible organizations. Verify the current rate at ecfr.gov as it may have been adjusted. The simplicity advantage is significant. Using the de minimis rate requires no cost study, no rate proposal, and no negotiation with a cognizant agency. Organizations simply apply 10% to their MTDC. This simplicity is particularly valuable for smaller organizations with limited administrative capacity. The trade-off is that 10% typically recovers less than actual indirect costs. Most organizations' actual indirect costs exceed 10% of direct costs. By using de minimis, rather than negotiating based on actual costs, organizations leave legitimate cost recovery on the table. The decision involves weighing simplicity against recovery. Indirect cost rates are not one size fits all. Various factors create rate variations that affect how you budget specific projects. Understanding these variations helps you apply the right rate to each situation. On-campus versus off-campus rates reflect different indirect cost levels for different work locations. Work conducted on your organization's premises uses more facilities and infrastructure than work conducted at external sites. Off-campus rates are typically lower because fewer facilities costs apply. Research versus other activities may have different rates. The indirect costs of supporting research may differ from supporting instruction or public service. Organizations with diverse activity portfolios may have separate rates for different functional categories. Multiple rates are common for organizations with complex operations. Your NICRA might specify a research rate, an instruction rate, an off-campus rate, and rates for other specific circumstances. Knowing which rate applies to which situation ensures accurate budgeting. Fixed versus provisional rates affect budgeting certainty. Fixed rates will not change regardless of actual costs, providing budget predictability. Provisional rates may be adjusted later based on actual cost experience, creating some uncertainty about final costs. Know what type of rate you are using when preparing budgets. Indirect cost rates are not permanent. Organizations must actively maintain current rates to ensure appropriate cost recovery and compliance. Understanding rate maintenance helps you avoid problems from expired or incorrect rates. Rate expiration means rates have defined effective periods. Your NICRA specifies the dates during which your rates are valid. Using rates beyond their expiration period creates compliance problems and budget uncertainty. Know when your rates expire and plan accordingly. Rate renewal requires submitting new proposals before current rates expire. Starting the renewal process early provides time for agency review and negotiation before the current rates lapse. Organizations should begin renewal activities at least several months before rate expiration. Interim authority may allow use of expired rates pending renewal in some circumstances. Federal policy has varied on this point, so verify current guidance. Even with interim authority, expired rates create uncertainty and administrative complexity that proactive renewal avoids. Rate changes mean new rates may differ from previous rates. Cost experience changes over time as organizations grow, build new facilities, or change operations. New rate negotiations reflect current cost relationships, which may produce higher or lower rates than before. Budget implications should be considered when rates change. Several common issues can complicate rate calculations and negotiations. Understanding these pitfalls helps organizations avoid problems in their rate development process. Unallowable costs cannot be included in indirect cost pools. Just as some costs are unallowable as direct charges, they are also unallowable as indirect charges. Entertainment, alcoholic beverages, and other prohibited costs must be excluded from indirect cost pools regardless of how they are funded. Cap compliance may limit certain cost pools. Federal regulations impose caps on administrative cost recovery, particularly the 26% cap on administrative costs for universities. Organizations must ensure their rate proposals comply with applicable caps. Cost shifting involves moving costs inappropriately between direct and indirect categories. If a cost has historically been treated as indirect, shifting it to direct to reduce overhead appearance while charging it directly to grants is improper. Consistent treatment is required. Documentation gaps undermine rate proposals. If you cannot document the costs in a pool or the basis for allocations, your proposal will face challenges. Building documentation practices that support future rate proposals is an ongoing organizational responsibility. Organizations should think strategically about their indirect cost rate approach. Several considerations inform decisions about whether and how to pursue negotiated rates. Rate strategy involves deciding whether to negotiate rates or use the de minimis alternative. Organizations with significant federal funding typically benefit from negotiated rates that recover actual costs. Smaller organizations or those with limited federal funding might find de minimis simpler and sufficient. Administrative capacity is required for rate negotiation. Developing a rate proposal requires cost accounting expertise, familiarity with federal regulations, and ability to manage the negotiation process. Organizations lacking internal capacity may need external assistance, which affects the cost-benefit calculation. Cost-benefit analysis compares additional recovery from negotiated rates against costs of developing and maintaining those rates. If negotiated rates would recover $500,000 more than de minimis but cost $100,000 to develop and maintain, the net benefit is clear. Smaller differentials require more careful analysis. Long-term planning recognizes that rate decisions have multi-year implications. Once you negotiate a rate, you cannot return to de minimis. Rate proposals establish baselines that affect future negotiations. Organizations should consider long-term trajectory, not just immediate circumstances. Successful rate negotiation depends partly on effective interaction with your cognizant agency. Understanding how to work productively with agency staff supports better outcomes. Relationship building establishes constructive working relationships with agency representatives. Rate negotiation is not adversarial. Both parties seek to establish fair rates that comply with regulations. Professional, respectful engagement creates a foundation for productive negotiations. Proactive communication means engaging early and communicating regularly. Do not wait until rates are about to expire to contact your cognizant agency. Keep them informed of significant organizational changes that might affect rates. Establish yourself as a reliable communicative partner. Responsiveness addresses agency questions promptly and thoroughly. When agency staff request additional information or clarification, respond quickly with complete answers. Delays and incomplete responses extend the process and may raise concerns about your organization's administrative capability. Documentation quality significantly affects negotiation ease. Well-prepared proposals with clear documentation, logical organization, and complete support materials enable efficient review. Proposals that require extensive clarification or contain obvious errors create friction and delay agreement. Following best practices in rate calculation helps organizations achieve appropriate rates efficiently and maintain them effectively over time. Start with good records because accurate cost tracking enables accurate rate calculation. If your financial records cannot clearly identify and classify indirect costs, rate proposals become difficult. Building strong accounting systems that support rate calculation is foundational to the entire process. Understanding regulations ensures you know current requirements before proposing. Rate calculation rules evolve, and proposals based on outdated requirements will face problems. Review current regulations at ecfr.gov and consider attending training offered by professional organizations. Seeking expert help recognizes that complex calculations benefit from experienced guidance. If your organization lacks internal expertise in indirect cost rate development, engaging consultants or advisors with relevant experience can improve your proposal quality and negotiation success. The investment often pays for itself in improved recovery. Planning ahead means beginning renewal well before rates expire. Rate proposals take time to develop, agency review takes time, and negotiation takes time. Starting early ensures continuity of appropriate rates without gaps or last-minute scrambles that complicate grant management. Let us summarize the key points from this lesson on calculating F&A rates. Indirect cost rates result from detailed cost studies documenting actual organizational expenses and negotiations with cognizant agencies to reach agreed rates. This process, while complex, ensures that rates fairly represent the relationship between indirect costs and sponsored activities. Cost pools aggregate similar indirect costs for allocation. Facilities costs, including depreciation, utilities, and maintenance, form one major pool. Administrative costs, including management, sponsored programs administration, and departmental support, form another. Each pool is allocated to activities using appropriate methods. The rate process involves proposal development, agency review, and negotiation to produce agreed rates documented in your NICRA. Organizations must maintain current rates by submitting renewal proposals before existing rates expire. Alternative approaches like the de minimis rate exist for organizations that prefer simplicity over potentially higher recovery. In our next lesson, we shift focus to personnel costs, typically the largest single category in grant budgets. We will explore how to calculate and justify personnel costs, document effort, and ensure compliance with federal requirements governing compensation charged to grants. Personnel costs are foundational to most project budgets. Practice exercise. If your organization has a negotiated rate, try to learn what cost pools contribute to that rate. If you use the de minimis rate, estimate what your actual indirect costs might be as a percentage of direct costs.